What is going on, guys? It is Josh from the Trading Fraternity. I'm introducing myself because some people have been asking what my name is from the stream, but I'm going to talk about selling premium, but how Warren Buffett trades options. And I'm going to go over a $5.6 billion option trade he's closed out on or about to, and another, I think, $35 billion options trade. So I'm going to go over that. I'm also going to show you guys a live example of me doing this, and we're going to go over it to talk about selling premium, what he does, and I'm going to show you, again, a live example from Boeing like you guys saw on the stream. So if you haven't seen that, the live streaming channel is in the description. It's in the comment section as well. We are trading live Monday through Friday. We start 30 minutes before market opens, so yeah, be there. Subscribe to that. Get ready for Monday. And also subscribe to this channel. We got the market updates and market watch lists and a bunch of other tutorials and stuff like this. And what else is important? Oh, yeah, you guys got to drop a thumbs up on the video. And I'm going to put, this is Tasty Work. So a lot of you guys who are already familiar with what we're doing with selling premium, this is that brokerage. I'm going to show you that. I got the referral link for us below, but I still recommend them if you guys have heard what I always say about that. But let's get to it. This is a hotly debated topic, okay? Because Warren Buffett, he actually, in the Berkshire Hathaway letters, and again, you guys could Google literally Warren Buffett selling options or selling puts, and you'll see a bunch of cool articles. This is from Forbes. This is actually pretty old, and it's discussing options that already exercised in 2014 he got paid on, but again, what Berkshire Hathaway has even stated in their letters, Warren Buffett refers to options and derivatives as weapons of mass destruction. So a lot of people, some people call this his secret weapon. They say, it's the secret trick he uses, but selling options is acting like a casino, or actually, acting like the house of the casino. But you guys see Warren Buffett, one of his biggest holdings that he loves and he's the man of is insurance companies. So he buys insurance companies, think Geico, but at the same time, he does that with options. So selling puts, selling premium is selling insurance. So if you guys have even seen the tutorials we've talked about, he pretty much is selling options. He's an options or an insurance dealer at the worst time. So like here on the S&P, this is what he did, and let me, pretty much he started in 2004 and 2007, and even now during the financial crisis in 2008. Does that show up on a 10-year? Barely, but even, 2008, 2009, at the lowest, he started selling puts. So it's selling insurance premium. He collects it. It's pretty much, it's a bet he makes on the market going up. And now one thing too, he trades different types of options. These occur on a lot of what he does is on the OTC markets, because, even this article and the articles talking about what he did, these are about, I think he sold 15, 20-year options, no exaggeration, and they're European style. So we are trading American style options. The question, can you exercise your option at any time? If American style options, the one we're trading here on the, the New York Stock Exchange, most of the time, unless it's OTC, they're going to be American style. But I don't know, some brokerage, you guys are all on some crazy stuff. But that is the European style ones that Warren Buffett sells. They all could only be exercised at the final date. So he's selling 20, 30-year puts out, saying that the market is going to be higher than this price, and that's it. There's no questions asked about that. So let's talk about what a selling put is. And you guys, I have this here for you, or, you could Google this yourself. I encourage you to look up Investopedia, great resource. Understand just the definitions of these. I'm going to give you guys my short versions. I explain things a little weird, but hopefully simple enough. And, I like to keep it simple, even though we touch on a lot of advanced stuff. But, go to Investopedia. Here it is, just explaining calls and puts. But to understand what selling a put is, and now this is selling premium. You guys ask me, these are what I've done. I did it on Boeing. I'm doing it here on some plays. I'm down 2,000 on this one. I'm down on actually all of these. I cut some profits today, but even on Boeing, that's what I did. Literally on this date right here, March 12th, 2019. This is, let's go back to Boeing, when the stock was dropping. And again, this recently, you guys have heard, I don't know if you have or you've seen Boeing, the 737 MAX 8 issue. We made a lot of money on puts, but that second day, March 12th here, I sold a put. So let's start now with understanding what is a put. We go to the option chain. This is, you guys see if you're familiar, calls on this side, puts on this side. So when you buy a put, it is, even on Robinhood, it says you think this stock is going down. it is like that in theory, but it goes a little bit more, I encourage, that's why I said Investopedia, understand the underlying topic with it. But how it is simply put, you guys are buying a put, you're buying the option for someone to buy the stock from you at a certain price. Again, let's read the Investopedia definition. You have the right to sell a security at a predetermined price. So again, let's looking here at the option trade. This is Facebook, for example. If you bought this put, you have the right to sell it to somebody at that predetermined price. So how does that profit you? If the stock goes down, then you can, let's say you bought this 165, this option, you buy that put, you're buying the right for somebody to buy Facebook from you for 165 a share. If Facebook drops to 160, they still have to buy it from you for 165 a share. So you don't even ever have to own Facebook and can buy Facebook at the open market afterwards, sell it to them, whatnot, or we just sell the contract. So that's the simple version of buying a put. So why does that matter? Because on the other side is somebody selling the put. So when you're buying it, somebody is saying, instead of, you're buying the option or the right to sell the stock at a certain price. So somebody is agreeing that they will buy the stock from you at a certain price. So reverse that. When you sell a put now, that's what Warren Buffett is doing. That's what selling a put is. When you see these accounts, instead of buying the option, because even if you buy a put, you're still buying something. You're still buying something, a contract that has value in the hopes of selling it for more money. But when you go and you sell the premium, you're shorting the option. And that's what he does. Warren Buffett. Now, selling puts, there's many logics behind it, and you'll understand why Warren Buffett does it. But at the same time, you guys could do it too as well. But it's taking advantage of volatility. So even in a market decline, a market crash, this is what people, especially Warren Buffett, like to do, because option premiums go up, especially puts. And if anybody knows, volatility is often overpriced. I believe even Warren Buffett has said that himself. So when volatility gets overpriced and people panic, you could sell those puts and you short the option. So when you guys have seen these options go up 1,000%, instead of buying the option, you literally short the option. So that's what we did. That's what I did on Boeing. I cashed out of that. Again, people were scared that Boeing was going to drop, all these issues. It dropped even a little bit the next day, but after holding up over this time, I made a 40% on that trade. The premium went up a lot in value for people protecting that, and that's what Warren Buffett does. So now here's why it makes sense for him too, because if you get exercise, because why would you want to do that? Why would Warren Buffett do that? Because at the end of the day, if when you buy the put, if you're wrong, you only lose your contract price, right? So if we bought the put, you spent the money, you didn't short the option, but you went long on it, and it went against you, you lose whatever you paid for the contract. However, when you sell the put, and this is what Warren Buffett does, the worst case scenario is you have to buy the stock. So if you sell a put at 140 or wherever, and I'll show you guys, this is what Warren Buffett does it on the indexes. He does it even on stocks like Coca-Cola. And this is what you guys could do if any of you ever want to buy a stock, instead of, it's a strategy even to scale in, you can go and sell premium on the put and, or sell puts on the stock and determine the price. But that's pretty much Warren Buffett does, where he could go out and he's literally, and again, he's selling 20-year options. So you guys are looking here. These are the retail markets. We can't go out 20 years. That's why he does it over the counter. That's literally hand-to-hand transactions, is people agreeing to make a market. We could go as far as we want, right? So September 2020, which is a pretty decent amount of time out, you could sell insurance on these. So literally he's going out to these options and saying, so a 1049, or 250, a 250 put. So excuse me, is that on the S&P? 250 is kind of surreal, but you go over here. I don't know why we have that up there, but you sell the put. If especially now, imagine the market was declining. Like, let's go see even during that whole issue in October. I wonder what these puts went to. These 240. These actually went in the money, so these probably went up a ton. They peaked out at $2,700. So he would have sold those options at 20, and again, this is probably too high for him, but by selling the put, let's say when the decline was happening, let's say January, if you sold the put, you would have collected $2,400 per contract. And, obviously you collect the premium up front, and you would be obligated to buy the S&P 500 for every one contract, 100 shares at 245. So, here's that Boeing trade I made. We could go back to that now, and you guys could actually see the stock in the exact contract. So on 321, I sold a Boeing, and then here's how it would look on Tasty Trade. Let's see, BA. There's the option strategy. So again, in literally, I like Tastyworks. It'll show it to you. I think I had a June 21st. So I'd go here. Here's on the option chain for you guys who have it or ask me. I need to make a tutorial on this, but you could go here to the June 21st, and I had three. Which ones were they? I don't even remember. I sold a 335 put for $11. So that's how much I got for it. $11 is $1,100 per contract, and you could see even if you guys wanted to sell it now, this is how it would look. I need to keep that up there. So sell the contract. So again, instead of buying this contract, what I did at the time, and let me put it up here, the June 21st. Oh man, it gets me really far here. So here's that 330. I like the charting on E-Trade. That's why you guys are seeing. But what you can see here, we'll go to the chart. But even when if I press review and send, it tells you what really the situation here. It says my max profit and loss. If I sold the contract today at this time, the bid is at $515. So it's saying the maximum P&L is $515. Now this is the thing about selling puts and selling premium. Even if you sold calls, your gain is capped. You only are able to collect how much you got for the contract. So think about it. When you buy a contract, the most you could lose is what you paid. If you sell a contract, the most you can make is what you gain. It's literally the polar opposite, but that makes sense. People buy, you can make crazy gains buying the option, but selling the option, the odds are in your favor because, again, most contracts expire. Think about insurance. Most insurance policies go unused, and that's even the logic Warren Buffett is utilizing in his insurance investments and selling these puts. So again, it's saying if the 515, and it's saying if the price of Boeing winds up greater than 324, your maximum possible profit is 515. So that's by the expiration date of June 21st. So why is it, it's a 330 put. So it's, again, you're agreeing to buy Boeing for $330 per share, but you're collecting $500. So that's why it says 324 at the end of the day. Even if it dropped below 334, as long you have a buffer of $500 before you really start losing money. So as long as expiration date comes around, then you make money. So think about Warren Buffett. He's literally selling billions of dollars on the S&P, especially when volatility goes up. And if it gets 20, 30 years out, and again, those European style options, so 20, 30 years later, if the S&P 500 or any of those companies, if it's higher than what what the strike price is, he just collects all the money. But he's doing it in massive quantities, literally billions of dollars in premium. But now the question is, why would he do that? What's the risk? Well, here you guys see, it says if the price winds up being less than 324, your maximum possible loss is 32,000. That's not really how it's going to work, because what's going to happen come expiration date, even if you're down, you'll get exercised and it will just turn into a short position, but you'll be down on it. Not a short position, you're forced to buy the stock. So again, you could just be down. Let's say now a Boeing dropped to $300, you're obligated to buy it at $330. You would lose about $3,000 on 100 shares. It'd be what, 100 or no, that'd be 10, 20, 30, that'd be $3,000 for one contract. That's the beauty of one contract here. But you would lose $3,000. You'd be down $3,000 because you would have to buy Boeing at $330, but that person you could buy it at the open market for $300. That's how you're taking that loss theoretically. But now you own the shares. So if the stock ever bounces back up, well, you could actually make your money back and some change. So that's, again, the logic of Warren Buffett. He's picking stocks he wants to own, and what he's doing with it is he's saying, hey, I'll sell the put premium, collects billions of dollars. He's selling massive amounts if he wants to buy a stock at a lower price. If he thinks Apple's great, but he wants to pay, Apple's at what, like $190. If he wants to pay, he's like, I like Apple at $100. He could just start selling the put premium on Apple, and he can now get either a couple $100 million, a couple $1 billion if Apple doesn't go there, and if it does drop, he'll just buy the shares like he originally planned to at the price that he wanted. So selling puts, again, even though selling premium is the most riskiest, I guess, form of trading options, when you have a plan and utilize it, and you see, just like Warren Buffett and Berkshire Hathaway, they utilize it to supplement an investing strategy. You can see how it could be used. So again, that's kind of there. And even on this play, you guys see, so I sold that on March 21st. So right here, or March 12th, excuse me, and I sold it. What'd I pay? Let's see that history. I sold one put, $335 at $11. So I sold it. I sold it pretty good. I sold it up here on March 12th for $11, and you can see at one point it was at $1,200. Even the next day it went to $1,258. But I pretty much, during this crisis, on that second day, it dropped a lot. I agreed. I said, hey, I'll buy 100 shares of Boeing at $335 and I sold the contract for $1,100 because somebody was willing to pay that much for me to agree to buy that by June. And then what happened? Boeing, it ended up dropping a little more, but then ended up going up. But pretty much I covered it. Actually, I covered it today. Yeah, wow. Time flies, man. Yeah, that's why I wanted to make this video for a few reasons, but I covered that today. It was a $335 put, and I bought it back at $6.20. So in that case, I made about like 45% on the option. And again, since it's American style, the most I could have made was another $400 if it went to zero, but I would have to hold it and I would still be liable. I bought it back at $6.20. I collected, 40%. And I bought it back again at $600. So the difference is that $400 or $500, and I closed out the risk. I have no more risk on it, and that's it. That's how I traded it. But that's how you guys can see how you can make money with these options. And I have a few other videos, but I want to use this as an intro to selling premium. So hopefully that helps. Again, I'm glazing over this. It could go deeper with understanding, but hopefully this will get you on the right track to now when you're watching some of these videos, when you're going through watching live. But let me know what other questions you have. Let's use this as our first lesson. So I'm gonna leave it there, guys. Let me know what you think. Let me know any questions you have, whatever you're confused on, and we'll talk about it on stream. Make sure you're subscribed, like the video, and be on the live streaming channel. And yeah, I love you guys. Peace out.